All right, today we're going to tear down the latest half-year financial report from British and Malayan Holdings, or BMH as we'll call them. We're going to break down all the numbers from an investor's point of view and really figure out what's going on under the hood.
So here's our game plan. We'll kick things off with the big headline numbers. Then we'll dive into the good news about their revenue. After that, we got to talk about a potential red flag, their cash flow. We'll take a quick look at their books, and then wrap up by seeing what the company is planning for the future. Sound good? Let's get into it.
Okay, so right off the bat, the main numbers in this report tell a really interesting story. It's kind of contradictory, and it's something we really need to unpack.
And here's the puzzle in a nutshell. On one hand, you see revenue is up. That's fantastic. It's exactly what you want. But then you look at the other side, and they're still losing money. So for any investor, the first question that pops into your head is, why?
Let's put some hard numbers on that. You can see their revenue climbed a healthy 17%, up to about 877,000 Singapore dollars. Awesome. But at the same time, they still posted a loss of $714,000. Now, to be fair, that loss is actually 10% smaller than last year, so that's a step in the right direction. But, a loss is still a loss.
Okay, so let's start with the positive side of all this. Where is this new revenue actually coming from? Let's dig in.
That 17% jump is a really great signal. The report says it's mostly from getting new clients for their trustee services. So what that tells us is that their main business strategy, getting out there and winning new customers, is actually starting to work.
And while getting more customers is key, there was another thing, something even more dramatic that helped shrink that overall loss.
And get this, a huge part of the better performance is from their share of profits from another company they're invested in. That number skyrocketed 113% to $153,000. This shows that their investments are really paying off and giving their bottom line a nice boost. Okay, but now we have to talk about let's call it the more cautionary part of the story. Because while their income statement is looking better, their cash situation, well, that tells a very, very different tale.
This is the million-dollar question, isn't it? I mean, logically, you'd think, hey, higher income, smaller losses, that should mean more cash in the bank. But for BMH, nope, the opposite happened. Their actual bank balance went down over these 6 months.
And you can see exactly why when you dig into their cash flow statement. There's this one line that just jumps off the page. Net cash flows used in operating activities. Basically, this is the money they're spending just to run the business day to day. In just 6 months, the company spent over 1.2 million Singapore dollars more than it brought in from its operations. That's a serious cash burn, and that's the #1 reason their bank account is shrinking even though revenues are growing.
Here's a simple way to think about it. Imagine you get a raise at work. Great. But at the same time, you start spending way more on coffee, lunches, you name it. Even with the bigger salary, if your spending grows even faster, you'll end up with less money at the end of the month. That's kind of the spot BMH is in right now.
So let's zoom out a bit from the day-to-day cash flow and take a look at the company's overall financial health. For that, we turn to the balance sheet. What we see here is that both sides of the books got smaller. Their total assets, so everything the company owns, went down. And that's mostly because of that cash burn we just talked about. But on the flip side, their total liabilities, everything the company owes, also went down by quite a bit.
And this brings us to a really big positive for the company, a major strength in fact. That drop in what they owe is because BMH has zero debt, no bank loans, nothing. That gives them a ton of stability and makes them much less risky.
So the big question is, how long can they keep burning cash? What's their safety net? Well, right now, the company has about $5.5 million in total liquidity. That's a mix of cash in the bank and other stuff they can sell quickly. This is basically their runway, the money they have to fund everything while they push to become profitable.
So you've got this mixed bag. Revenue is growing, but they're burning through cash. What does the company itself say they're going to do about it?
Well, first off, they're not trying to sugarcoat things. Management comes right out and says that their main market in Singapore is tough. It's crowded, it's competitive, and it's a real challenge.
And here's their plan to win in that tough market. They're basically going to double down on what's already working. They want to get even more customer leads, boost their brand so more people know who they are, and look for new partners to maybe create some new ways to make money. So, if we put it all together, here's the summary for an investor. The strengths are pretty clear, right? Revenue's growing, their losses are getting smaller, and they have no debt, which is fantastic. But these are balanced against some pretty serious risks.
that high cash burn, a really tough market, and the fact that they absolutely have to keep that growth going.
And that really leaves us with the ultimate question for British and Malayan holdings. It's basically a race against time. Can they grow their revenue fast enough to finally turn a profit before they burn through that $5.5 million cushion? The answer to that question is going to decide this company's future.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.